how do you pick a unit trust that suits your needs? Well, today we'll show you how to distinguish between different unit trust offerings and whether their underlying assets suit your personal savings needs in terms of age, income, risk profile, and desired income. For that, we're joined on the desk by Don Richter, financial planner at PSG Konsult, and Natasja, Hart, financial planner at Sasfin. Thanks so much for joining us. I'm going to go out on a limb here and say that there are a lot of people who actually don't know what a unit trust is. So let me take the plunge and let's take a couple of steps back. And if you can, perhaps, Don, just set out in lay terms, what is a unit trust?
Basically, everyone is familiar with shares that are listed on the JSE, and I think it was around about 1965. We followed the start of unit trust. So instead of owning one particular unit, you could now own a unitized unit in a collection of shares. In simple terms,
perhaps just putting that in pictures, I could own now a little bit of BHP Billiton, a little bit of Anglo-American, a little bit of Standard Bank. That's what we're talking about here.
Correct. And since 1965, in America it's known as mutual funds, and here it's called unit trust. And it's had a massive transformation over the years, where the industry has transformed itself dramatically over the last couple of years. But essentially, a unit trust is a small fraction of a bigger unit that you collectively invest with other investors.
Is there traction out there? Are we finding that the retail investors are sophisticated enough to go the unit trust route?
I mean, I'm a little bit cynical on it. Yeah, I mean, I think there's 900 odd unit trust products in South Africa. I mean, we're tiny. I mean, I think there's 440 listed shares and we have 900 unit trusts. I think there's been a lot of products that have been created. And I think this comes back to the original question, what's a unit trust these days? Because people, there's so many products that are sitting out there that people don't actually know what they're buying anymore and why they're buying them. And I think that was why we started talking about, Garth and I were talking about this topic this week, is how does somebody actually pick out of a variety of options that are out there?
Garth, your thoughts on the topic?
I think one of the problems is that people think a unit trust is a unit trust is a unit trust. Yeah. And they forget that it's actually a product. So the best way to think of it is, imagine you're giving your money to an asset manager who's then going out buying shares, bonds, money market instruments, etc. But he's tailoring the combination of those instruments into different products. And the different products suit different people according to their risk profiles, their age, etc. So you as a end consumer, you have to decide which of those products suits your circumstance best. And
well, now that's the difficulty. With 900 products out there, how exactly, once you've got your head around exactly what a unit trust is, how do you go about choosing the right one?
Well, I think it starts with understanding your own needs. Why are you investing? What's your objective? And the easiest way to link it is to the time frame that you're planning to invest. Now, I must put caution here. The time frame shouldn't be aligned like when I retire, I'm going to change my investment profile. If it's a retirement profile, that profile should carry on throughout your retirement as well, because we know the eighth wonder of the world is compounding interest. And you get that by investing long term. So understanding your objective with the investment, if it's for a holiday or a shorter term, then you need to look at the underlying assets. So you're going to look at something like cash or interest bearing so that your capital is not exposed to the market volatility. If it's longer term, you need to determine that what growth you need. And that should determine the composition of the investment. Only then do you start looking at other factors like the cost of the portfolio, the manager, the research that you have access to decide which fund is the right one.
I think Garth and I think it a little bit differently, because often, you know, the argument everyone has is look at a small cap fund, and it's this whole question of maybe it's financial media play a big part in it, is performance. So now we go and we look at a small cap and done brilliantly for a year, and you're going comparing it against a guaranteed fund or a balanced fund or whatever, and people are going out there buying performance, assuming obviously historical performance therefore means this is what's going to be achieved going forward, and they're not comparing like for like. And I think the industry is not doing itself too many favors in terms of creating so many products that are balanced, guaranteed defense. I mean, it's too complicated as it stands at the moment, and then you're having this situation where the media, completely at fault, then goes and tries to compare it like for, you know, trying to treat it as like for like.
We find the same thing. I mean, we find that investors try to compare an income fund with an equity fund. They would blame you for poor performance in an income fund relative to their equity counterparts, and it's simply not comparing apples with apples. And I think the industry needs to probably tighten a little bit on the definitions, and I believe they have done so in the
Not tighten, simplify the definitions, make them easy to understand.
Well, I think they have done so to a large extent, but still not enough.
I'm a BCom graduate, I still don't understand half the definitions out there.
I also think the onus is also on the end consumer again to educate themselves. We were talking again before the show, and I've certainly seen this with family and friends. Some people literally don't want to know because they prefer to outsource the responsibility to someone else, and then when the outcome isn't what they wanted, then they can moan at you. Whereas if the outcome isn't what they wanted and they made the choice, well, it's a little bit harder to blame yourself for some people. So I really think people need to take the time to sit down and look at the underlying product and find out what is best for them at their particular time. And quite frankly, what's good for you might not be good for your mate who's the same age and has the same profile.
Well, Garth, there, a case in point, if you're going to take the time to investigate what your needs are, why don't you then just choose which shares to buy and buy your own basket effectively?
Because, well, my view on that is I don't think 99.9% of average Joes sitting at home in front of their computer are going to beat the likes of Alan Gray, Coronation, Investec, etc. Even as a financial journalist, there is no way that you have the depth of knowledge that those guys have got. I've just seen it. They spend tons of money on research and on hiring top people. You sitting at home in front of your PC is not going to beat that.
Are they beating the benchmarks though? That's the big question. The likes of Coronation, Alan Gray, etc. This goes to active versus passive. Should we not just be buying into the index?
Now you've just opened a whole new can of worms, because
That's my job.
So it's not just selecting the unit trust, it's the underlying investment theme that the manager is applying. And I mean, for the investor on the street to do it by themselves is not going to happen. And yet there's a big drive towards cutting out the intermediary. But I think that's where the intermediary plays a vital role, to distill all the noise, to distill the information and help the end consumer identify their own needs, because the end consumer doesn't always know their own needs. Now, to answer your question, do they beat their benchmarks? It all depends on the time frame that you're measuring it against. And the important thing that has been stated is past performance shouldn't be a driver for your decision-making
Which makes
process.
it very difficult to select the product then.
And just to make another cynical comment, which I like doing, is if we're saying that consumers are struggling to distinguish between the different products, well then what makes you think you're going to be so clever as to be able to beat the asset managers at picking shares? I'm not saying that people shouldn't invest in shares, but I'm not so sure that you should be putting all your retirement income effectively just in your own hands and relying on your own knowledge when there are professionals out there that are
paid to do it pretty much 24/7.
It's interesting to note that PPS, I think, recently did a study where they compared returns over 10 years. And basically, if you had selected the winner of the previous decade and you had stuck with that same winner for the following decade, from 2001 to 2011, you would have returned 368%. Had you stuck your money, or had you swapped from the worst possible performer the previous decade to, and you stuck with that for the following 10 years, you would have made 457%. So you would have been better off going with the worst performer of the previous decade. So it's very dangerous to be following performance only.
It's also a way of taking your own emotion out of the equation, I think, by letting someone else do it and just keeping an eye on them.
But still, how do you choose? If past performance isn't the barometer, what is it?
What's the message that's come through here? It's a decade performance. Sticking to your strategy will deliver. Research has shown internationally and locally, and for once locally we've done better than America and Australia. If the fund over a 5-year period performed in double digits, the individual investors had single-digit returns and in most cases negative returns, because they didn't stick to their strategy through that whole period. So what you're finding is chasing returns, and that's once again removing the noise.
To answer your question about how do you pick the right product for you, I would say, I think too often people go, it's do it according to your age. If you're young, be very aggressive. If you're older, be a lot more conservative. Obviously, there's merit in that. I'm not denying that, but a young guy who is, let's say, a trust fund baby who's got his house paid off by his parents, he's got a beach house in Cape Town, he's got a business his dad bought him, he can afford to be a lot more aggressive with his money he's already built up, say, in unit trusts than the average Joe who didn't grow up like that.
Or he's not a trust fund baby.
Yeah, exactly. So you might want to be a little bit more cautious with the money you've already accumulated. So once you've accumulated a sizable portion, maybe put it in a slightly safer fund, balanced fund, perhaps balanced plus, and then your contributions you make thereafter, then you can go very aggressive, because then even if the market falls, you're buying cheap.
I mean, maybe one of the things I find interesting, I thought I could trade and you'd be better than the market over the long run. And I mean, it's fun. You have a little bit of fun and games in the early years when you can't afford.
Are you admitting that you're not beating the market?
I'm useless. Yeah, but I mean, the point being that one of the things that I found very interesting was, in the last couple of years, I've started to actually have a financial planner. So, and what I find interesting is that the product mix that they essentially choose from is a very simple mix. I mean, there's not complicated. You're not looking at these sort of outlying funds, and you're basically getting a standard balanced product. And what does irritate me, though, is the number of the younger financial planners come and they roll out their laptop with the performance graphs that say if you put 100,000 in now, it's worth $1 million. I mean, what that really shows is compound. It doesn't show real return, and I think that frustrates me from a way that the unit trusts end up getting sold.
We're almost out of time, but Don, perhaps just a final question to you, and that is, of the 900 or so products out there, what does your universe consist of? So if I come to you and say, listen, I want to engage, what have you got in your portfolio to show me that you would choose from?
We would normally follow ratings that are covered by Morningstar, and they normally cover the top 240 unit trusts.
So we've still got a lot of work to do in
Sure.
terms of selecting one of the 240.
A lot of the work's already been done for you, because there is a measure of volatility, so they do look at standard deviation, you do get Sharpe ratios, so there's a lot of tools that would help you in ascertaining when a fund manager is consistently good, or whether they just had a lucky sort of break.
You want to make a final point?
Just a final, it's like picking a car brand. Go with what floats your boat, and with a brand that you like and you trust. I like Coronation. I've met the guys. I like them. There's other companies I like as well. But the point I'm making is, just pick a brand name and find out about that company, find out about their past performance, and if you believe in it, then as long as you keep an eye on them, you should be okay.
Bottom line, keep it simple.